I get a lot of questions on YouTube about tax planning for retirement. People ask if I use some kind of a certified tax planner or any kind of a tax expert. I haven't yet, but I'm not opposed to it. It's something I may do in the future. I'm just doing it on my own at this point in time. People are understandably nervous about tax strategies, making the right decisions, and their tax implications. One of the problems with tax planning is you can be tempted to optimize for current rules, but rules change. The best plans are flexible. Tax laws change every year. Plans need to be adaptable. I can share my tax planning in hopes that it gives you somewhere to start, but please remember, I'm not a tax expert or any kind of financial advisor. One of the best retirement strategies is to be poor on paper. I've talked about this many times before. Looking poor to the government can be really helpful in retirement. There's nothing illegal about it, and I personally don't think there's anything wrong with it. You're still paying taxes, just less. I'm a rule follower. I certainly pay my taxes, but I don't want to pay a huge amount. I can't afford to. The IRS doesn't look at your net worth and only cares about income. The more income you have, the more taxes you pay. In retirement, they only count it when money comes out of pre-tax retirement accounts or produces income. Traditional pre-tax accounts like 401ks and IRAs create reportable income in retirement. Money that you pull out will count as income the year you withdraw it, which will increase your taxable income. If your income is lower, you'll pay less taxes, even if your net worth is higher. I have a modest income, but my net worth isn't extremely modest. My mortgage is paid off, and that makes a huge difference. I have a video about my net worth. If you're interested, I'll link it below. If you can swing it, paying off your mortgage will increase your net worth, but you won't have to pull as much income from your retirement accounts without a mortgage payment. When you pull less from your pre-tax retirement accounts, you have lower income and therefore lower taxes. Another thing that's really helpful is having after-tax savings like Roths, health savings accounts, brokerage accounts, CDs, or high-yield savings accounts. Withdrawals from Roths and health savings accounts are tax-free. With the others, you only pay tax on the earnings. So here's my current plan. In 2025, I think I'm going to be in the 10% tax bracket. I just haven't been spending as much as I originally thought I would. From January through July, when I turned 59 and a half, I had my taxable pension, which is $800 a month. I've averaged around $1,000 a month from YouTube because I had a couple of really good months on YouTube. YouTube income is taxable and does have additional self-employment taxes. I had $1,050 from my CD ladder each month, and just the interest is taxable. So my monthly gross income has been around $2,650. But my taxable monthly income was only $1,650 a month because the principal in the CDs isn't taxed. My CDs were purchased with after-tax money. Then from August through December, I'll have my pension, my YouTube income, and possible withdrawals from my pre-tax retirement accounts. I just need to get my monthly income up to that $2,650. So my taxable monthly income for the second half of the year will be $2,650 a month. So the first half of the year, the taxable income was $11,550. And the second half of the year will be around $13,250. So my total taxable income for 2025 will be around $24,800. This is about what I was shooting for. If it was much higher, I'd be pulling money from my high-yield savings account during the second half of the year instead of my pre-tax retirement accounts. The new standard deduction for an individual for 2025 is now supposed to be $15,750. So after I subtract that, my taxable income will be around $9,050. This puts me in the 10% tax bracket, and I'll pay around $900 in taxes. I will also have that 15.3% self-employment tax on my YouTube income, but that doesn't affect my tax bracket. Income taxes are progressive in the United States, and many people misunderstand how they work, thinking that their top rate is what they'll pay on all their income. Here's the 2025 income tax brackets. If my taxable income was over $11,925 but under $48,475, I'd be in the 12% tax bracket. So I'd pay 10% on the first $11,925 and 12% on the rest. And of course, I'd also have to pay that additional self-employment taxes on my YouTube income. I can deduct some business costs, so I'm hoping it won't be too bad, and I have been paying quarterly estimated taxes. But say my same yearly gross income, $31,200, was all coming from pre-tax accounts like it was when I was working. So if you subtract the standard deduction, that's $15,450 of taxable income. I'd now be in the 12% tax bracket, and I would pay $1,616 in taxes instead of that $900. $1,193 of that from the 10% bracket, and $423 from the 12% bracket. To me, that's a lot of money. It's almost twice as much. My gross income didn't change. It was just all pre-tax in this scenario, like it was when I was working a W-2 job. And you can imagine how much it would go up in the 22% or 24% tax bracket. In future years, I can use money from my cash bucket number 1 or from my Roth in order to keep my taxable income in the range I want to. I'm also planning on withdrawing some money from my pre-tax accounts and putting it in my Roth each year that I can. I can do this because I have earned income from YouTube, and if I do, it might be like $5,000. I'm waiting till the very end of the year to see where my modified adjusted gross income is before I decide to do this. At my modest income level, I really won't have to worry too much about taxes, future RMDs, or future IRMA Medicare charges. But you might, depending on your income. Retirees with higher incomes get hit hardest with taxes. Planning ahead and having a good portion of your nest egg in after-tax savings can make a huge difference to your tax bill. Roth conversions are another strategy to look into if you're tax planning. You do have to pay taxes when you convert to a Roth, but once that money is in a Roth, it grows tax-free and there's no RMDs. If you retire early, you might consider converting some of your pre-tax funds to a Roth before you start Social Security. After you stop working full-time, if your income is lower and you're in a lower tax bracket, this may be a good time to do it. I've also had questions about planning for inflation, and that's definitely important. My small pension has a COLA, and Social Security will too once I start that. So I'm hoping to average 7% growth on my portfolio. That way I have 3.5% safe withdrawal rate and 3.5% to cover inflation. I know inflation can be higher and returns can be lower, but with this plan I'd never even touch the principal. These are all just guesstimates for planning purposes. Tax laws change all the time. So do financial situations, but you get the idea. Plan ahead for taxes in retirement. Keep your taxable income low, pay less taxes, and keep more of your hard-earned money. You've earned it. So what did I forget? Do you know any other tax strategies I didn't cover? If you want to share, feel free to leave a comment. If you're seeing me for the first time, hi, I'm Julie and this channel's Happy on Monday. Thanks for joining me. If you found this helpful, please like. And if you're interested in retiring early, consider subscribing. I'm going to leave you with a quote. The best things in life are tax-free. Hope to see you again soon.